I think as it's been famously said, either you can have a good news or you can have good price. We have seen a rapid growth of profit to GDP to 4.7% level. India stands rock solid in terms of macro stability and the domestic demand growth. From investors' perspective, I think it's very important for investor to stick to asset allocation discipline. Let's go.
Welcome back to our second episode of this Wealth Insight podcast, where we continue our conversation with Anand. Welcome back, Anand.
Thank you.
In the first episode, we went through how do we see H1, how do we see H2 panning out, and what are the risks and opportunities. So, kickstarting from there, when you look at equity investing, everyone talks about the power of concentration. And when you talk of PMS and AIF investments, you take a lot of equity concentrated bets. But investors are very wary because there's also risks in that. So how do you back such big names and ride that position over its entire journey?
The way I see, it's not as much concentration as much it is more sector agnostic, more benchmark agnostic.
Yeah.
So I think the way to see is while you might invariably see concentration, but the more important part is how much of the portfolio is bottom up, how much is there a conviction of an individual company, individual stock in the portfolio, and whether I'm able to display that completely. I think that's more important than actually only concentration.
Yeah.
I think concentration is just one part, but how far away you are going from the index, how much underweight and overweight you are vis-a-vis benchmark is a reflection of the risk you have taken in the portfolio. And that's just the beginning. That's just the structure. But eventually to generate alpha, you need to get it more right than wrong.
Yes.
So first step in generating alpha is to go away from the index. But the second, then it's getting more right than wrong. I think that's more important part of the journey of any fund manager.
So how do you build that conviction? Because in alternate investments, since the concentration is much higher, so how do you build that conviction to have big positions in that particular equity stocks? Because as you mentioned, there are risks in that. So what is the philosophy behind in building a particular stock position in your portfolio?
So within the portfolio, so that comes in the realms of the portfolio construction. Within the portfolio construction, particularly when we're building a high active risk portfolio, or as you call it, more concentrated portfolio, and as I call it, more index agnostic portfolio, we need more conviction. And that's where the large team comes in. So every stock that becomes a part of the portfolio goes from multiple levels of filter, a set of selection and elimination before it comes and becomes a part of the portfolio. To give you an example, today we have our research team. We have a strong, large research team of 24-member plus team. They identify 600 plus strong businesses that they believe can be bought at this current juncture. On top of it, we have our funds management team, which is again a fairly strong team with lots of experience. We have at least two people, evaluating that and confirming that this idea should be part of the portfolio. So that's what is the key. We have this 6I principle that every stock that becomes part of the portfolio should at least have three people who would have vetted that idea before it becomes part of the portfolio.
That's very interesting, Anand. And before I go into how you build alternate investments in your overall traditional portfolio, I wanted to touch base on your investment philosophy. You all follow the BMV framework, which is business, management, and valuation. Could you elaborate on that?
Indeed, BMV is a very critical and a very important aspect of the entire stock selection. It stands for business, management, and valuation in that order. So a lot of time first is spent on evaluating the business. And within the many things that we look at business, the three most important aspects of business is growth. I think we invariably will look for businesses where the growth is far better than the nominal GDP growth rate. So we're looking at sectors growing faster than GDP and companies growing faster than sector. Second important aspect is moat, or we call it sustainable competitive advantage. It has a twin benefits. One, in a growing market, it helps you gain market share, grow faster than the sector. But I think its critical aspect of moat is also you're the last man standing. You have a certain sustainable competitive advantage which allows you to survive the bad times. I think that's also very important because invariably There are cycles, there are good times and bad times in every sector.
Yeah.
We have seen that in telecom. At once upon a time, everybody was making money in telecom, and then there was a point of time when nobody was making money in telecom, right? So you need to survive the downturn in that sector. So the moat, sustainable competitive advantage, is the second element. And the third is what we call it HHI, we call it consolidation versus fragmentation. So typically, a lot of wealth creation is along with the sector consolidation when the pricing power or ability to charge the customer improves. Again, case in point, what we are seeing today in telecom versus what it was few years back. And if it's fragmenting, then generally it's very difficult to make money, and most probably you will lose money as number of players increase in any sector. And that's what you saw more recently in paints business, right?
Yeah.
So we prefer the sectors which are consolidation versus fragmenting. So that's the B part. M, management, we're looking for competence, we're looking for corporate governance. Again, I can dwell upon it for a very long period of time, but I will stop there. And last but not the least is valuations, that a good business and good management at a reasonable price. I would not say it has to be very cheap. It won't be cheap. A good business, good management will always come at a price, but we are not ready to pay any price for a good business and management. That's a discipline on valuation we are maintaining.
So taking a cue from that, Anand, how do you build alternate investments, these long-only concentrated strategies, in your overall portfolio, and how is it different from the traditional mutual fund investments which you do?
So again, I've been saying this for a while that look, in mutual fund, it's a group of people with somebody as little as 500 rupee SIP also in that, and to that extent, the risk appetite of mutual fund should be different from a risk appetite of an HNI who's investing minimum 1 crore in any AIF, right? So I think the way at ICICI Prudential we are looking at is that the internal risk limits, our ability to be going away from the index is much more in AIF than what it would be in the mutual fund. I think that's the key difference. That's where I started with that. The key differentiation as far as alternates versus a traditional mutual fund would be one's ability to take risk vis-a-vis what it's the case with the mutual fund.
So final question, Anand. You've had a very long investing journey. In fact, you've had from mutual funds, you moved into alternate investment. What is one core belief which you think, or investment philosophy, principle, which you think will stand the test of times and stand the test of market cycles?
I think at the end of the day, cycles will come and go.
Yes.
And we have seen that time and again that people do get too optimistic about the economy at times, and at times you can become too pessimistic. But in a very long run, if you have seen, the earnings growth of the corporate India is aligned with the growth in the GDP.
Yes.
And in the very long run, if you see, the market growth rate is aligned to the earnings growth rate.
Yes.
And to that extent, every time people get too pessimistic, your market cap to GDP falls, or your near-term returns are very bad, I would actually be very comfortable investing. And every time people get too excited, when the market cap to GDP is also very high, and the near-term returns are also very high, typically one should reduce the allocation to equity. So that's what an investor can do. Otherwise, as far as the asset class, money management, stock selection is concerned, you already have fund managers which is doing it.
Thank you, Anand. It's been a very insightful conversation over these 2 episodes. Thank you for taking time out and joining us on this Wealth Insight podcast.
Thanks, Vinay, for having me. It was an absolute pleasure to be here on this podcast.
Thank you, listeners, for joining in this special episode of the Wealth Insight podcast, where we had a very insightful conversation with Mr. Anand Shah. Stay tuned for more such insightful wealth conversations with industry experts. Thank you.